So the Bitcoin price just fell. Can you believe it?
You can't make this up. Binance just had a flash crash in the price of Bitcoin
by 87%.
It went to a low of around 8,200.
Whale games begin.
Last Thursday, Bitcoin took a massive dive, crashing 87% from its recent all-time high prices. We saw unprecedented movement from around $67,000 all the way down to $8,000. Prices we haven't seen since the beginning of 2020. And it turns out that this crash was mostly isolated to Binance US. Other exchanges like KuCoin and Coinbase didn't see a correction of the same magnitude. However, most did see Bitcoin dump at least slightly in the same time frame. This kind of event is called a flash crash, and it isn't the first time this happened, and it won't be the last. So let's discuss why this happened and how you could profit off something like this next time it happens. The last time that Bitcoin made headlines like this was when earlier this year, Tesla announced that they would stop, or at least now pause, accepting Bitcoin as a mode of payment for their cars. And that helped cause Bitcoin to tumble below 30 grand, a correction of about 50%. And it's taken the better part of 6 months for all-time high figures to be seen again. This time, the around 87% dip wasn't due to highly influential news. In fact, Bitcoin has been seeing a lot of investor love on the heels of recently announced futures ETFs for the coin. But according to sources inside Binance US, this anomaly occurred because of a glitch in an institutional trader's algorithm. This created a massive accidental sell-off. Now, crypto is pretty volatile, but it's hard to imagine that one bug could wipe out millions in open positions. Bybit at the time was showing more than $500 million in liquidated positions, the highest liquidation amounting to $10 million. And this may have all just been a bug or some kind of genuine accident on the part of this institutional investor, but the repercussions here were very real, especially to leveraged traders. In the articles that I looked into, one tweet kept on showing up. They then pointed out that drops like this are more likely to happen in US-based exchanges because of, quote, unreasonably thin books. And many traders who were hurt by this event echo this same sentiment. So why the dip, and why primarily Binance US? If it was only one big investor selling off, why did it look like nearly the entire market would get wrecked because of it? Not even the biggest whales could have had that individual power, assuming that they would all act independently, of course. Just take a second here to understand what Binance US actually is and why this happened. Arguably, the most important thing to know is that Binance US is a separate company from Binance, the international crypto exchange. These two companies operate independently, with the US exchange having a license to use software, trademarks, and wallet technology of the original Binance brand. Until 2019, Binance had been accepting users from the US into its international platform. But because of pressure from regulators, this was quickly put to an end. All new US users would be funneled into Binance.US, who at the time was introduced as a partner company. But even then, the US counterpart isn't available in every US state, limiting traders on the platform even more. New York and Texas, two of the most high population states in the country, are notoriously left out. Still, one of the biggest draws for Binance US is the trading fees. Trading can be done for as little as 0.1%, 5 times cheaper than Coinbase's minimum of 0.5%. That's especially helpful to investors that spread out their buys with dollar cost average strategies. What raises concern is the competition Binance.US has in the United States. Exchanges like Coinbase, Kraken, and even DEXs like Uniswap each have US and international traders on their platforms. With fewer traders, and by extension a smaller number of average trades, it gets a little clearer as to what was implied on Twitter. And because of this, I looked into the ranking of the top 100 biggest crypto exchanges in the world by 24-hour volume to further quantify this notion. And Binance.US, sure enough, is outranked by Binance International, Mandala Exchange, Coinbase, FTX, KuCoin, and many more. By no means is Binance.US the smallest exchange by traded volume, but it so happened that this error occurred on a platform in which the order book was much more vulnerable. Due to this, a small mistake by just one institutional investor on the exchange can easily overwhelm the order book, causing massive price movements isolated to that one specific exchange. And this seems to be exactly what had happened. Now, I wanted to talk a little bit about how this happened, specifically in relation to order book depth, also called depth of market, or DOM for short. In this case, it's basically a full list of all outstanding orders for a cryptocurrency. You put in a sell order for Bitcoin at 80K, your neighbor puts in a buy order at 60K, all of that data is kept in the order book. The more orders there are, whether to buy or sell, the more we can understand about the asset's price. Depth of market is a way for investors to measure supply and demand in real time, and it can be incredibly helpful in short-term trading, especially when traders are looking to either enter or exit positions extremely fast, within minutes in some case. Usually when a stock or currency has many willing buyers and sellers, it's likely that there's a high circulating supply of that asset on an exchange. This is referred to as the asset being highly liquid. The trouble starts when there aren't as many buyers or sellers, or if there's an imbalance between the two. Too many sellers mean the coin is in high supply with no one filling the orders. Too many buyers means high demand but little supply, with not enough currency or stock circulating to keep the order book moving. This balance is just a small part of what determines the going price of an asset. If an exchange has low liquidity, a shallow market, it means that large buy or sell orders can make the price swing wildly in either direction. However, what's pretty much inevitable at that point is that traders or sometimes bots seek out opportunities for arbitrage. They'll find unusual prices on one exchange and then quickly buy up the cheap asset to sell at higher prices on the other exchange, constantly seeking these price mismatches. And believe it or not, this behavior actually keeps prices between exchanges very close to one another, on a normal day at least. So going back to the October 21st Bitcoin flash crash, a glitch in the system of a large institutional buyer falsely signaled a massive sell-off on that exchange. This skyrocketed the supply within minutes without nearly enough demand at the moment to stabilize the price. What I want to point out here is it's difficult to say for sure whether that shock of sell-off would have impacted other exchanges the exact same way. Because for Binance US to drop 87%, an exchange whose circulating supply is close to 600 Bitcoin or $40 million, it seems like many leverage traders could have also been liquidated on other exchanges as well, because it was obviously a very significant issue. Now the question remains, is it possible to profit off of a flash crash like this? And the answer is yes, it's possible, but you'll likely have to be prepared ahead of time. This isn't the last flash crash we'll see. Even as Bitcoin's price becomes more stable and it grows, other cryptos will be vulnerable to market systems acting in odd ways in the future. So the most simple way to profit from a flash crash like this is, of course, buying. In the case of this 87% dip, your time would have been extremely limited though, as the opportunity lasted a very short period. But most flash crashes are around 10% or less, not 87%, giving us a slightly larger window of opportunity. Sure, if you happen to be looking at the charts and saw that 87% dip, you could have made a purchase right away, as I'm sure some Binance users did, but more likely than not, most of the purchases at the bottom were done with bots or limit orders. If Bitcoin is trading at $60,000 and you have a limit order set for $30,000 just in case, you may be able to pick up some ultra cheap crypto. A few notes here though. In the moment, you won't likely know why the price is dropping, and it may dip further down after you buy. All flash crashes so far have recovered completely. However, there's always a risk of the future acting differently. And on top of this, just because you have a limit order set doesn't mean your order will absolutely execute. Because remember, there needs to be liquidity in the order book in order for a trade to finalize. Another possible way to make money would be shorting crypto on the way down. However, this seems so impossibly risky to me that I wouldn't recommend this strategy. The issue with shorting is Bitcoin's price has only gone up in the long run. So you're effectively fighting against that momentum, which of course increases the risk. As in life, usually the best option is the most simple. Flash crashes happen in crypto, and buying those crashes in the past would net you quick 5 to 10% profits on average. There is of course high risk of it dropping further though, because you're effectively trying to time the market. However, a strategy of dollar cost averaging on red days, dips, and flash crashes could prove to be an effective strategy. Of course, not financial advice. Now back to the story, I don't want to downplay the impact that this might have had on your Bitcoin position. Even if you didn't have a leverage position on Binance US, you may have had a stop loss order triggered, closing you out at the wrong time. But if you were using leverage, I'm curious to know how this affected you. Let me know in the comments down below. Some leverage positions actually didn't even get affected at all, surprisingly, even though a crash like this should have definitely wiped them out due to exchange leverage ratio requirements. So there's a lot of questions that we don't have public answers to quite yet. But this is one of the reasons why playing with leverage shouldn't be taken lightly. Sudden price movements, whether caused by anomalies or bad actors, could have huge effects on your money when you're borrowing to invest. And it's extra unfortunate when things like that happen just because an accident on someone else's algorithm. However, now that you have the knowledge about how these things happen, you should be able to use this to better understand the markets and potentially profit off of abnormal trading days in the future. And one last thing, make sure you check out this video's sponsor, BlockFi. With BlockFi, you can earn interest on Bitcoin, Ethereum, and stable coins. And by making an account, you can get up to $250 in free Bitcoin. So I'd like to thank you so much for watching, and I hope you have a profitable day.